Well, yeah, I mean, I think with investing, the reason the error rate is high is because of, I would say, primarily two reasons. One is that humans have a tendency to basically project present circumstances to infinity. So, for example, you know, we have a company in the US called Nvidia, and Nvidia just hit $1 trillion market cap, and it's up almost like 200% this year in the first 5 6 months. And Nvidia is a great business. It's a great business. It's at the epicenter of the AI boom, and a lot of people think that Nvidia will do really well. I don't have any position in Nvidia, and I'm not suggesting you should go buy the stock, but I'm just using it as an example. So I would say that there's a lot of euphoria around Nvidia. And if one were to do some type of analysis of a discounted cash flow model, where you look at the earnings of Nvidia today and you do some projections of what you think their earnings are in 3 years or 5 years or 10 years, and then you discount it back, I think it'd be difficult to justify the $1 billion or $1 trillion market cap. It'd be difficult to come up with a future cash flow stream in the next 10 years or so that would exceed that. I have no idea what would happen to Nvidia, but I would just say that what I have noticed in equity markets is that they vacillate a lot between fear and greed. They tend to at times get very overheated and overvalued, and they tend to get very depressed at other times. And because it's auction-driven markets where prices are set by the sentiments of investors, there's a lot of positive sentiment about Nvidia. It's a great business. But similar sentiment existed in early 2000 with Microsoft. And so I remember that when I started my fund in 99, one of the first individuals, probably the first 20, 30 investors I had, was a guy Indian guy who had risen quite high in Microsoft and had retired early. And he was one of the very early employees of Microsoft. He knew Bill Gates well, worked closely with him and so on. And he had made an investment in Pabrai funds, and he told me, hey, listen, if you're ever in Seattle, I can introduce you to a bunch of current and former Microsoft people. And these guys are quite wealthy. They've got a lot of stock options from a long time ago. And some of them may be interested in investing in your fund. And Pabrai funds was very new, just like, a couple of $1 million, $2-3 million in assets. And I said, oh, I'm going to be in Seattle day after tomorrow. So he said, oh, that's great. So he walked me around Microsoft, introduced me to different people. A bunch of them later invested with me. But I told many of those individuals I met that their livelihood was coming from Microsoft. Most of their net worth was in Microsoft stock or in Microsoft options that had been granted. And when I looked at the Microsoft market cap at that time in early 2000, it was over 600 billion. It was in the top 3 most valuable companies in the world at that time. The top 3 most valuable companies were Cisco, Microsoft, and General Electric. None of those would have been a great investment if you put, a portfolio 1/3 each in these 3 investments. GE has basically, for practical purposes, disappeared. Microsoft never saw that 600 billion market cap for the next 13 years. And in fact, it took a huge drawdown. I mean, the 600 billion went down to, I think, less than 100 billion or so, thereabouts. So it was a huge drawdown. It's now at a much higher valuation. So it's done really well. But I think from 2000 to 2012 or 2013, it would have been a very, very rough and bumpy ride. And I don't know anyone who would have held on to their stock through that ride. And the Nvidia situation today, so the history doesn't repeat itself, but it does rhyme. And when I look at the Nvidia situation today, to me, it rhymes a lot with the way Microsoft was at that time. It was just the blue chips, great business, recurring revenues. How can you do without Word and Windows and Excel and all of that? And so it's an important, I mean, now the other thing about investing is that there are no called strikes. It's a baseball term. You can let a lot of balls go by and there's no penalty. You only could possibly get a penalty if you try to hit something. So if I don't make an investment in Nvidia, and Nvidia ends up being a $10 trillion company 10 years from now, I don't really lose anything. Yes, I didn't make that 10x, but what matters is what I actually invested in, what happened with those things. So Nvidia could be 10 trillion, a few years from now. It could be a few hundred billion a few years from now, or even less. We don't know. And so one of the reasons for the error rate is, like I said, people get caught up in the euphoria, flavor of the day, fear of missing out, and all of these things. Another reason why there's a high error rate in investing is we are trying to predict the future trajectory of a business. The future trajectory of a business has so many different unknowns and variables. A great manager leaves, or a great manager comes in, or government regulations change, or there were duties which prevented competitors from abroad coming in, and those duties go away. So there are myriad of factors internal to the company, external to the company, that or with competitors that could affect the future outcomes. And so when we are trying to, look at a business and say, oh, I think 5 or 10 years from now, this will be worth, 3 times what it's worth today, that's an exercise that's prone to, by definition, a high error rate. And so we need to be aware of that. And I think that in general, having a strong dose of pessimism, investing in the interesting art, you need to be a pessimist and an optimist at the same time. Kind of keep two thoughts in your head at the same time. And if you can do that, then that can work out quite well.